Hi, I'm Kevin McDevitt from Morningstar. We're here at the Morningstar Investment Conference, and I'm joined by Steve Wymer from Fidelity. Steve, thanks for being here.
Glad to be here.
So Steve is the lead portfolio manager at Fidelity Growth Company. I want to ask you a couple of questions about the types of companies you like to invest in and how you differentiate. And in particular, I want to know, how do you differentiate between, let's say, a promising, innovative company that's doing something interesting and exciting versus one that's also being innovative, but that you think is a better shot at capturing value for shareholders?
I think it all comes down to when someone's either innovating or moving their business forward are they going to gain a real competitive advantage? So if one person has the innovation, whether it's a patent or some know-how, time to market advantage, scale advantages, or other things like that, that's differentiated from the market, they're probably more apt to capture value. Whereas if 5 people have the same insight, 5 people have the same know-how, 5 people have a similar time to market and no different distribution advantage, it might be a little bit more competitive. Therefore, perhaps lower returns for that investment.
When you're talking about things like first to market, and with so many technology plays these days, it seems like there's a big network effect in place as well, or there can be if you're the first to market. Talk about that a bit. Do you see it with a lot of companies?
So I'd say the first to market's been magnified quite a bit in the digital phase. You can network a lot easier digitally than you can in the real world.
Sure. Let's talk also a bit about companies that, again, are being innovative but may not be profitable yet. How do you get comfortable with companies like that?
Well, sometimes you have to invest ahead of the curve, and so therefore you have to, if you don't have a core business, you generate losses before you go forward. But what we're always doing, whether it's for an existing company or for something more in a startup phase, is we're looking at discounted future cash flows. So we're looking way out in the future what those profits can be, what those cash flows can be, and then discounting back to the future. So sometimes we just start from a loss position, and that's part of the equation.
And do you have like a threshold in mind? I mean, are you willing to wait, say, 2, 3, 5 years? Does it depend on the company? What are the things you take in consideration there?
It depends on the company and the industry. So an area where development typically has taken longer has been the healthcare industry. So the development there, because of human safety involved, due to regulations involved, trying to get through the government's approval, both in the US and around the world, those are longer term processes. So many times it could be a decade or a longer process, whereas if it's digital, it could be a lot quicker, and in the physical world, it's usually somewhere in between.
And, in a lot of these cases, I know you do invest in IPOs, you invest in secondary offerings. How much are you also looking at burn rate, at how quickly a company is going through its capital and how it's also using its capital?
Burn rate's part of the equation, so burn rate tends to add dilution or takes away cash. It can lend itself to dilution, and dilution means there's less for the shareholders, so it's part of the equation.
Okay, great. Steve, thank you so much for your time.
Thank you.
And thank you for watching.